What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are taking a look at Eli Lilly stock. The stock is down over 3% today, and this stock has had an incredible run. So, a year ago, this stock was 570 bucks. In the middle of this year, we went all the way up to 950. Then the last 5 years, we're looking at up over 500%, which is just insane. And so, I want to take a look to see, is this stock a good investment at the moment? Because if you look at their financials, they have lots of good numbers. There's a couple bad things, but it's a lot of good numbers. So revenue the last 5 to 10 years has averaged anywhere from 4% to 10%, right? The last couple of years have been, this past year was really good, right? 34 billion in revenue. Okay. So revenue is looking good. Then, well, free cash flow was negative last year, which is not great, but net income is up, and that's the important thing. See, now this is one where, so last year they did 5.2 billion in income. I would call this pretty consistent. It's not super consistent because there's lots of ups and downs, and there's a couple of years where they lose money, right? But the good thing is, I would say, like, for this 10-year period, they averaged $1 billion in income, let's say. And then this 10-year period, the average was higher, right? Now they're averaging like 3 billion, let's say $2.5 billion. And then this 10-year period, the average is more like $4 billion, right? And then this 10-year period, it's looking like it's going to be more like $5 or $6 billion. So it's not super consistent, but it's fairly consistent, and it's good enough. It's not like we're seeing a bunch of drop-offs back to, you know, numbers from 20 years ago. That's not what we want. So that's a good thing. Here's a bad thing. The cash is 3 billion, the debt is 18 billion. So not great. So keep in mind, though, this company can do 5 or 6 billion net income in a year, which means they could probably pay this off in like 3 years, really. They're consistent with the dividend. That's good. Shares outstanding is coming down. That's good. Return on capital employed, 28%. That's strong. Profit margin, we're looking at 15% for this past year. And really, you can see that, if anything, I don't want to say this is tough because this one is kind of fluctuating a lot. It's not consistent, and it's definitely not getting better. It looks like it's getting a little bit worse decade after decade, but whatever. It is what it is. I mean, as long as they can keep growing net income and revenue, then that's all that matters. Now, as for the valuation, now here's the interesting thing. I used FinChat, which is a chat bot, to find the median PE ratio for this stock is 37. Okay, now wait till you see this PE chart because it's all over the place. It's one of the craziest ones I've seen. But the median is 37. That's what's the important thing to remember. So 5 years ago, the PE was 12. Then this year, the PE was 114. That's how wide this range is, okay? So where do you put the average? I mean, if I was going to guess, I'd guess the average is probably maybe 40, something like that. So the average is 37. But most of the time, you put a higher PE if the stock is growing more. And what we can see is that this past year, their EPS went from 6 to 13. It doubled, and more than doubled. Then it's expected to all nearly double again next year, 13 to 22. So the growth has been insane for last year and going into next year, right? Revenue is decreasing a little bit by next year, but it's still incredibly strong. 33, look at these numbers, 34 billion in revenue, 45 expected this year, 58 expected the following year. So the numbers are phenomenal right now. And actually, FinChat actually has analyst estimates for 2026 EPS of $29. So the growth is going to, it's going to slow, right? It's going to slow down to whatever, 15, 20%. But $29 a share is a lot. And so the growth is, it's not like this is going to be a company that grows 3%. They're expected to put up solid numbers, right? But if we take that median PE ratio of 37 and we multiply that times next year's numbers, I mean, we could do this year's numbers too. For this year, the stock should be, let's say it says 481, right? So 481 is fair for this year, but we're almost done with this year. And investors are expecting these numbers to go up. So realistically, going into next year, we're looking at more like an $814 stock, okay? Now, the stock is coming down though, because the news is kind of like, the sentiment's not great right now because RFK is going to be in charge of the health department or whatever. And they're saying that's going to mix up things and it's unpredictable and it could be bad for Eli Lilly. Whatever. You can't predict things like that. The bottom line is this company has put up strong numbers decade after decade, and the growth is expected to be incredible this year and next year and the following year. So we don't know what's going to happen with that. You still have to price in the risk of things and weigh out the risk, right? But if we want to be realistic, I mean, we're talking the last, whatever, 10, 15 years, the stock on average trades at 37 times earnings. And they're going to be doing 22 times earnings roughly next year, and then 27 or 29, whatever it said. I think it said 20, whatever it said. Yeah, 29. So we're looking at this for a fair valuation, it should be 814 bucks. I mean, the stock has just reached 114 times earnings. So think about that. We're coming down from 114 times earnings right now. I think we're at like a 70 or something right now. But 37 is a lot lower than 114. And sure, can a stock trade at 10, 15 times earnings? Maybe. I don't know how bad, how realistic that is. Things have to get really bad, which I don't know if that's realistic, but is 25 times earnings realistic? Yeah. I mean, in a really bad scenario, sure, this stock could be 500-600 bucks, right? That's realistic. That's very realistic. If things keep heading south, sure. But I would put a fair valuation of $814 going into next year. So does that mean the stock is a good buy now because it's trading, $100 under that? I would say not really, because as we just said, the stock could be 500 bucks. I think the stock could, I mean, what happens if we put a crazy P ratio? What if it trades 80 times earnings? Okay, well now the stock can be, who knows, $1,500, $2,000 in a year from now. It's possible. It's not realistic though, especially with growth slowing. So I'm gonna say 814 is the fair valuation for next year. It could be 500 next year and it could be 1,500 next year. It is very hard because the P ratio has been so crazy, but they have strong growth numbers. And I think it's going to be a little bit worse. So it's probably not going to be 100 times earnings, but it could be 70. This could trade at 70 times earnings, maybe. Um, but the bottom line is I'm probably not buying this right yet, just because I have to have a lot more, I have to have a way bigger probability and a lot more upside potential than downside potential. And right now it's looking more like 50-50. Right now it's looking like, even though I think the stock's worth 800 bucks plus, I think there's an equal chance the stock goes to 600. So if the stock goes to 600, well, okay, now the things are more in my favor, and now we're looking at like a 60% chance, right, of things moving up and me making better money. Um, so that's the way I look at it. If it's 600, if it goes down more, definitely under 650. But if it goes to 600, then I'm gonna be interested. Then I'll be interested in buying. So that is my analysis for Eli Lilly. Let me know what you guys think down below. I will see you in the next video.